Let's get straight into the strategy. This strategy is the intra-bar continuity strategy. So, how exactly does this work? Well, we first need to understand what intra-bar continuity is. So, intra-bar continuity is an observable phenomenon that occurs during the activity of an open candle. So, as we know with typical candlesticks, you have something that looks like that over there, then you'll typically have wicks at the top and also wicks at the bottom like that, right? And we obviously know that if this was a green candlestick that went up over here, right? So if we had to color this in green here, we would know that this is the open of the candle over here, then it would move up. This would be the close of the candle here. This would be its highest point, and this would be its lowest point. So when we speak about the open of the candlestick, it's literally just when it opens and almost like a flat line like that. So if we come to pocket option here, you will see that when this 1 minute candlestick basically opens and starts a new one, it will start completely flat. So watch this. There, you see how it starts completely flat? And then if you give it a couple of seconds, there we go. Now it starts moving and creating movements like that. So that's something very important that you need to remember. Obviously, it's the complete opposite with a sell. So if this was a red candlestick, for example, like this, obviously it doesn't look like this, but I'm just coloring it in so that you have reference. The candlestick would open here, and then it would obviously move down and close there. This would be the highest point it was at, and still here the lowest point that it was at. Let's continue though with the intrabar continuity method and strategy. So the theory of the intrabar continuity is pretty simple. How it is going to work is we are trying to place trades based on the pullback of a candle high. So the candlestick, as I already explained, will open like this. It will open like that, and then it will create a movement like that. Either if it's deciding to go up, right? If it's deciding to go up like this, or whether it's going to open like this and decide to move downwards, right? And obviously that would be red, something like that, right? Now, for a green candle, because it's going up, this would be the high over here, right? That would be the high over there. Obviously, because there is no wick yet, this becomes the high, right? Obviously, if there's no wick here yet, this would not be the low, right? This would be the low because that's the lowest point it's currently at. This is the highest point it's currently at. So we see here for a green candle, right, where we would ideally be looking to take buys, we see that it creates a new high at this candle over here. The opposite is true with a candle low. Now you're going to see exactly how this theory and this strategy will work very soon. So after it creates a high, right, so it will open here and then it will move up like this, or it will open here like that and move down like that, we will then notice a thing called a pullback. So I already explained to you guys how the market works. It creates impulsive moves and then pullbacks. Impulsive moves, pullbacks. Impulsive moves, pullbacks. Because the market can't just go constantly in one direction, it has to have a type of exhaustion or a pullback, right? So if we're deciding to go up, there will be pullbacks where it comes down. If we're deciding that we want to go downwards, right? If it's this, the market's deciding it wants to go downwards, it would have an impulse and a pullback. Impulse, pullback, impulse, pullback, impulse, and pullback. These would be the moments of exhaustion, right? On a candle stick, how this would work is it would obviously, maybe for a sell, or sorry, for a red candle, it would move like this, right? This would be red. Okay, and then if it decided to pull back, instead what would happen is, if I use this box, it would do something like this, right? It would move like this, right? And then this would be completely red, and then it would move back like that, and then it will end up leaving that wick called a pullback, or just like the shadow in general that we obviously know about, right? And that obviously happens between the two over here. You obviously saw that it creates that move upwards or it creates that move downwards. So here, creating that move up, this one creating that move down, it will get to the point over here where it had moved upwards like this, but then after it moved up, it moved back down to this point over here. And what that does is it creates a first pullback. Now, because it created that first pullback, it leaves a wick behind, okay? Now that creates the new candlestick high over there. The complete opposite is true for a sell, where it would have opened and moved down like that. This candlestick would have moved down, but then it would have moved back up like that, leaving this trail or this wick over here, and consequently and subsequently the new candle low. Let's going to make more sense very soon. Just stick with me. All right. It's a very powerful strategy. So what we know with the intrabar continuity strategy is that there is a high probability that after a fresh pullback from a newly created high or low, the price will attempt to retest that same level with the same candle. So immediately after the price decided to move all the way up and back down like that, we have a very, very high probability, statistical probability actually, that it will retrace back up, because we obviously know that in a trend, if it goes up like that and down, it has to move up again to create that continuation to the upside, right? So almost the move up like that was this move over here. So maybe if I use some colors, you will be able to see. The main move like that would have been this one, right? Then the pullback down here would have been the one that created the wick, or this one over here. And then the final move, the one that we are trying to trade, will be the one continuing back upwards. And this is the one that is likely to occur. It is completely oppositely true for a sell, right? Where you would have that main push down, right? And that would be the push down like that. Then you would have a retracement upwards like this, and that would be the retracement like that. And then obviously the main push back down, which is the one that we are trying to trade over here, which would be this one, because in a downtrend it would have to continue. So that's exactly what we're trading, right? Let's continue though. So like I said, there is a high probability that after a fresh pullback from a newly created high or low, it is likely that it will continue back towards that high or back towards that low, depending on what candle you're trading. And this principle applies every time the new high or low is formed during that candle's life. So what that means is when a brand new high forms, so let's say we went and we broke into even higher points, we could then wait for another pullback and then another push up. If this went into lower points over here, we could wait for that push down, that pullback, and then obviously take this trade to the downside, or obviously here, take that trade to the upside. So keep that in mind. Now, after that, any pullback that occurs before the price returns to that high or low is considered valid under this entry. So what that means is every time, let me maybe clear this. Actually, let me see. Yeah, let's just use this one again. So what it pretty much means is when it moves up like this and pulls back. So maybe let me actually delete this and clear it up so that we can see it a lot clearer for the buy and then obviously for the sell. So like this. Pretty much what it means is whenever it creates that new high, like we obviously explained over here, obviously for the buying example, for as long as it's retracing below here and continuously moving down, we always have opportunities to take buys. The same here. For as long as it creates that new low over here, so that new candlestick low over there, as long as it stays above this most recent low here and continues moving upwards like that, we always have opportunities to take sells. That's exactly what it pretty much means. So after that, any pullback that occurs before the price returns to that high or low is considered valid, like I already explained. However, once the price reaches that same high or low, again, after a pullback, the setup is no longer valid at that point. The principle can only reapply if a new candle high or low is created. So what that means is if this price if this candlestick over here reached all the way back here, up here, and equaled this level up here, it's not a valid place to take that trade anymore. Same over here. If this candlestick ended up going back here and was touching this point, it would not be valid anymore. It only becomes valid if it starts pushing even higher and then creates another pullback, because then we can take another trade there. Same here. If it started to push even lower and created another pullback, then we can start to take trades to the downside again. And we're going to see exactly how that's going to work very soon. So like I said, after that, any pullback that occurs before the price returns to that high is considered valid. However, once that price reaches to the same high or low after the pullback, it is no longer valid because it can only reapply once a new high or low is created. Let's quickly recap how this works, and then we're going to show some examples on the chart. So as already explained, the theory applies after every new high or low is created during a candle's life. So pretty much meaning that if this was a candlestick going up, so if this was green, it would only be valid if this ended up pretty much going from that and created a new high above this point here. And then obviously conversely for a sell, if this was a candlestick going down over here, it would only be valid if it pretty much ended up going below and breaking this low over here and creating a brand new low, right? Where it would then pull back, we could take sells, and oppositely here for this buy over here, if it created a pullback and we took buys. It's pretty much the concept of it, right? Any pullback is valid as long as it is the price has not returned to that higher low. So pretty much any pullback is valid on this candle or this candle as long as it stays pretty much above this low over here, so that we can continue to look for trades to the downside, or as long as it's below this high over here. So as long as it's pulling back like this, we can take trades to the upside, right? That's exactly how it works. Now, once the price revisits that same high or low after the pullback, the setup expires and a new high or low is required to restart the theory, which I explained pretty much, I believe it was somewhere over here. Yeah, where pretty much the only way you could have a new opportunity is if it broke a new high for a green candle and then retrace back down, and then you could take trades, right? If it touches this point here but it isn't creating new pullbacks, then you can't take the trade. Same here, it has to break that previous low into a lower low, wait for a pullback to come up, and then you take the trade down. That's exactly how it's going to work. Now let's look at some examples, right? So let's look at this red one. We have the creation of a candle over here. Oops, let me use the yellow one. We have a creation of a candle over here. We had its low over there, right? And that would be its most recent low, where it then created a pullback, which we're going to break down over here. You see that that new candle low was formed there, and then it created that pullback over there. Now, we will see that I actually think I may have reordered these incorrectly. It's meant to be like this. There we go. Yeah, I think so. Wait, no. I'm going crazy, guys. Here. So you can see that that new candle low forms, right? The new candle low over here forms and it pulls back. So when it pulls back like that, we know we can take trades to the downside. You obviously, we're going to see that we're basically going to be on 1 minute candlesticks, right? We'll be on 1 minute, I can't type in, 1 minute candlesticks, and we're going to be taking 5-second trades, right? That's exactly how it's going to work. So we see here that it created that new low over there, pulled back, and then we could likely take that opportunity to the downside. And what you'll see on this exact same setup is that it creates and actually ends up pushing lower, right? And trying to break that low. Now we can see that this even continues to break it even more. So we see the candlestick low breaks out over here, which now means that we can take another trade as long as it pulls back, because this is going to be the brand new low, correct? So we can see here, this will be the brand new candlestick low. Now all we're waiting for from here is a pullback. And then after that pullback, we give it a couple seconds, we can take that 5-second sell. That's how it's going to work. So we see here, it creates that new candlestick low. We have that first pullback, we can take trades. And what you'll notice is that it's going to push down even harder, right? And pretty much covering that wick over there that was like that and covering it completely. So here's an example for a buy. So for this buy, this candlestick over here creates a brand new high, right? As soon as it creates that brand new high there, it creates a pullback. So now we know we can take opportunities to the upside and take buys. What do we notice? The candlestick ends up going from when it used to be like that, it just ends up covering it and creating a push to the upside. We're going to see some live examples just now so that you can have a better understanding. Now, when it reaches this point over here, you cannot be taking buys, right? Because it hasn't pulled back yet. You need to wait for that pullback, and then once it's pulled back, you can take that trade to the upside, right? You can see here that it's breaking the new high. You still cannot take buys here because we're still waiting for the pullback and then the trade to the upside. This will obviously create a brand new high. Okay, so we see here the previous candlestick high was broken out of, and this creates the new high over here, which will likely be broken down in the next image. Here we go, a brand new candlestick high. Now we're waiting for that pullback, and then we can take the trade to the upside, right? So there we go. There's a very strong pullback, right? The first pullback that we see. So then we will be able to take a 5-second buy over here and ride that move up. And you can see that this was pretty much aligned at that point over there, which is like roughly over here. We would take the 5-second candle and 5-second trade, and we would win off of this move over here as a move back up after that pullback, right? Very, very simple stuff, very, very powerful. And you can see that it continues to push even higher and higher and higher. Now, let's break down the brief explanation of the strategy. So, according to the intrabar continuity principle, once a pullback occurs, it is assumed that at some point during that phase, the price will move back from either the initial pullback level or from any subsequent pullback level within the pullback segment in the direction of the most recent high, low, whichever was formed first. Pretty much just saying that when it creates a new high, right, it will push down and then it will more than likely push back upwards. And then the same for a sell, right? So over here, exact same for a sell, where if it creates a new low, right, it will always pull back up and it's more than likely to push back down and reach that low or that previous low. Okay, now if it pulls back and originates, or if the pullback originates from a new high, the price is expected to move upward and remain above that level for at least 5 seconds. That is exactly why when we take that 5-second trade, we have an advantage because we are essentially riding something called the momentum and the volume of the market. So very important concept is the momentum of the market that we're pretty much riding with and the volume, right? And all that we're doing is trading towards areas of liquidity, right? So if this is a green candlestick, right? If this was a green candlestick over here, so let's highlight the screen. This was a green candlestick, and what happened was previously it would have looked something like that, correct? It would have looked something like that. The candlestick would have moved up, but then it would have retraced downwards. Now, when it retraces downwards like that, we can take buys. So we would take the buy. Now, what would happen is it would look something like this. So it would be like that, and then the candlestick would end up pushing above its high. And what you'll then notice, all of this would be green. However, this candlestick and the trade that we take to the upside will always ensure that it will stay above our entry point for at least 5 seconds. That's why we take the 5-second trade. The opposite is obviously true for a sell, where this would pretty much all be red. So if this is the main red move down here, so change the color. If this was the main red move here, we would then obviously have the retracement to the upside like that, and that would create somewhat of a wick that looks like that. This would be the red candle over here. Now we would take that 5-second sell, and it is more than likely that from this level over here, we can stay below this level for the next 5 seconds and get that payout. Like you already obviously know with quick trading and with the strategy, you place the trade and it will count down, right? So we obviously know it's a 5 seconds, so it would obviously count down from 5 all the way to 0. And if you're trying to take a buy, it's likely just going to stay above until it hits 0. You make 92% payouts. Obviously, the opposite for a sell, it's going to move down until you hit 0, and then it's going to close here. As soon as it hits 0, the trade closes automatically. You get a 92% payout. We'll get into like the numbers and the risk management and how to allocate your trade sizes in the next video. This is more just breaking down the strategy overall. So now let's get into the strategy itself, right? Actually, before I do that, let's look at a couple examples on the chart so that you can get a better understanding. So here we will see very soon a low. So there we go. There's our low broken over there. As soon as that gets broken, what will you notice is a likely continuation to the downside where we can continue to take trades. There we go. Can you see how it's pushing down? These are all trading opportunities to take these sells, right? It's as simple as that, right? So that's the most recent low over there, and you can always see that the candlestick likes to push down for 5 seconds. There we go once again. Why? Because it's trying to grab this liquidity area at the bottom here and also use the momentum and volume of the trend, right? So when you are trading, and I'll get into this after the breaking down how the strategy works and the trades and stuff, but you need to add additional confirmation. And how you do that is you need to look at the overall trend, right? So the overall trend over here is down, which means that we should only be taking sells, right? Only be taking sells or only looking at the red candlesticks to take trades off of, okay? If it was an uptrend like this, we would only be wanting to take buys. Okay, meaning we will only be looking to take trades off of the green candlesticks. Okay, so like look at this candlestick right here. Because we're in a main downtrend over here, we would not want to be entering off of this green candlestick, because what could happen is if we were trying to take sales of this, the candle could just shoot upwards and we're pretty much going to be losing, right? So we only want to be trading off of the red candles when we're moving in a downtrend, or green candles if we're moving in an uptrend. Very simple stuff. Okay, so how do you identify a downtrend? Well, if you just look at your charts, you can see if it's going down, then yes, you're going to look for sells off of the red candles, right? If it's an uptrend, you can see it's clearly going up, and you're going to take buys only, right? Buys only off of the green candles that are forming, right? So because we're in a downtrend, we can start looking at this candle because it's currently red, right? All that we're looking for is that low. There we go. Now, can you see how it created that low? What's going to likely happen? It's going to likely pull back. And did you see how it pulled back there? We would then take that 5-second trade, right? Let's possibly look at other charts for you to see. So here again, what do we see? Well, another downtrend, right? Another downtrend. That should be your first thing to tick off. You need to tick off what is the trend, okay? Then you need to tick off what is the candle color. So the candle color here, from what we're seeing, is obviously a red candle, which means that as long as it stays below this low over here, we can continue to look for sells. And what you'll see, as this will continue to push, right? It will continue to create moves to the downside from where it was. There we go. Another push downwards. This would be a win, right? That's all that you need to look at, right? You need to look at the trend that you're in, right? You need to look at the trend that you're in and the candlestick color. And if they match, you can start looking for trades. So because we're in a downtrend here, we've got a red candlestick. You see that low that formed over there? Because we had a pullback like this, we can start to look for trades to the downside. And what will likely happen is you'll see a lot of rejection to the downside as well on these trades. Of course, sometimes it might go green. You're not going to win every trade. That's completely normal in trading, right? But you get the point now, right? You get the point of how this would work. Once again, another downtrend, which means that we are only trading red candles, right? If it was an uptrend like this, you would only be trading green candles, because that's where the, if you remember, momentum, right? That's where the momentum and volume within the market lies, because you are trading with the trend and you are corresponding that with the color of the candle that you're trading as well. Okay, keep that in mind. Now, let's do an example of a buy so that you can see how exactly it would look, right? So this is quite a choppy market. Probably want to stay away from this because you can see there's a lot of these like long wicks over here. Also, the market's quite bouncy like this. You don't want to be trading in something like this. You want clear movement where it's either creating clear highs going upwards or clear lows going downwards, right? So that would obviously be examples like these where it's moving a lot better. Okay, so let's look for an uptrend so that we can obviously see green candles. It looks like a lot of these are bearish markets pushing downwards, but we will find an uptrend. Here we go, right? So here's an uptrend. You can see this is like a much better market. Because this is an uptrend, we only want to be taking trades off of these buys over here, or off of these green candles, right? Majority of these green candles. So what we're going to do is we're going to wait and see what happens on this candle. It's more than likely that it's going to create a green push because the trend is so strong, the volume is strong as well. So let's see. Let's see if it decides to push upwards. Currently, this is the most recent high, right? Okay, now this is the most recent high there. You see that high there? You see how it's pulling back now? Watch how likely it is to continue to push upwards because of the trend that we're in, right? And if it doesn't work out, then that would just be a loss and you would write it off. But you can see, even though from there you would take another trade to the upside and it's still pushing, you can see there's a lot of buying pressure upwards. And those are the trades that you take. Although it looks like a red candle, because it's a 5-second trade in a 1-minute candle, you are actually able to take trades from down here even, place the 5-second buy, and it stays above that point and you win, right? As simple as that. You can see that even though it started off as a red candle but then went into a green candle, that shows buying pressure. And although it goes into a red candle like this, you can see from down at the bottom of this point, it's been pushing up. You can see it's still pushing up, right? As long as it stays below this high over here and keeps pulling back, we can continue to take buys. So what do we notice here? There's our high, right? It's pulling back, so we can start taking buys to the upside. And look what happens. It starts to form more and more moves to the upside as well because of that buying pressure and because of the fact that we're trading in an uptrend. So I know I say when you're trading in an uptrend, only look at the green candles. But if it shows green at any point in the candlestick, then that's a good trade to take. Look, look, look. Look how it's gone now, guys. You remember it was like very, very, very flat. Now it pulled back and now it's pushing even higher because we're trading with the trend. It's okay if it goes into a bit of red because it's staying below that high. You can see it's staying below the high. It's going to pull back. Here it's creating a new high, right? So when it pulls back, it's going to push up. There we go, right? You see how this works, okay? So even if you're in an uptrend, it's fine if you're seeing a red candle at that moment. That's because it's actually still below your current high, right? And you can continue to take trades. All I'm saying is that you need to identify if you're in an uptrend, you should only be looking to take buys and only be looking at the most recent highs like this, okay, that were formed. Whereas if you're in a downtrend, okay, if you're in a downtrend like this, you only want to be looking at all the candles and the most recent lows in order to be taking only sells, right? Trade with the trend. And how does that work in a downtrend? It goes from highs to lows to lower highs and lower lows, lower highs, lower lows, lower highs, lower lows. Okay. Then an uptrend, high, low, high, 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 low, higher, high, high, low, high, high, right? That's how you take your trades. Now, how will the strategy work? So the rules of it are pretty simple. Okay. You need to set the expiry time on pocket option to 5 seconds. You already know this. We've broken it down. You need to make this 5 seconds on your pocket option. But now to adjust it, you need to make your candlestick time frame 1 minute. So just click that M1 over there. So you can see it, use 1 minute candlestick time frame. Wait for a new candle to open. Once the new candle opens, observe the first pullback that occurs from the candle's high or low. If the pullback is from the candle's high, you immediately place a buy option. Right? If the candlestick, so you immediately place the buy option. If the pullback is from a candlestick low, you immediately place a sell option, right? If the trade results in a loss, wait for another pullback within the pullback segment and place a new trade in that same direction as the previous one. If the candle where your trade sequence started closes before you reach your profit target, continue the trading process with the next open candle starting again from step 4. Repeat this process until you either reach your daily profit target or hit your stop loss. I will break down exactly how these targets will work, how the money management will work, and how you can allocate your risk safely in order to be profitable and make some money, right? So let's do a couple examples over here so that you can see. And then what we will do in the next video tomorrow is we're going to break down a live session. So we will actually do a live session. But before we move into that live session, I will break down the risk management, right? I'll break down the risk management and exactly how much profit you should be aiming for based on your account size, but also what your trade size should be as well, right? So if you're doing like $100 trades, what should you be aiming for, right? Typically plus 12 units. What should your stop loss be at? Typically minus 5 units. We'll obviously get down into breaking that down a lot more in the future of this entire free course. But the whole idea is you take your account size. Obviously, I have a very big account size. So if I had to take 1%, right, because that's the main golden rule, is you take 1% of your account size, relay it into your profit target. Whatever your profit target is, multiplied by plus 12 will equal to your take profit, and then multiply by minus 5 will equal to your stop loss. That's essentially how it's going to work. And then you'll obviously be taking like those $100 trades. If you obviously had a $10,000 account, you would be taking $100 trades. But for the sake of this video, the next video that I'm going to be doing when I break down the live session and the risk management, I'll just be doing $100 trades for you to see. But yeah, it's literally just 1% of your total account size, right? Which will then become your trade size. For example, $10,000 account would become a $100 trade. You would then aim for 12 units. So the $100 equals to 1 unit, right? That $100 being 1 unit, you would then aim for plus 12 units for your take profit or minus 5 units for your stop loss, okay? So it's pretty simple stuff. I've broken down the fundamental basics of how this entire strategy works. You can go test it for yourself now. I highly recommend sticking to it on demo and getting used to it, because this obviously is not financial advice. This is completely up to your own risk, whether you want to risk your own money. But the only advice I could give is practice on a demo account until you're confident. Okay. And In the next video, so we've obviously gone and broken down the entirety of the intrabar continuity strategy over here and how it does work. In the next video, we will do a live session, pretty much actually taking the trades itself with the $100 trades, but we will also be breaking down the risk management as well. And then the video after that, probably some psychology, and then a final conclusion. And that will be the end of the free course. But guys, if you have been finding this very valuable, I have more value and I share more value inside of my quick trading community, which you are more than welcome to join. And the stuff that we teach in here is so advanced. It's even better than what I break down here. And I know what you're seeing here looks really advanced and really cool and really profitable. But the stuff inside of here is just incredible. Like if you look at the classroom, all the modules over here, we've got 2 courses as well that you can get access to. It's just incredible. And we also give you live calls every single Saturday for the beginners and every single Sunday for the advanced guys, where you learn brand new content live. You can ask me questions, you can speak to me, and you can actually even watch me trade live as well. So it's really, really exciting stuff, really, really cool stuff, and also a lot of money to be made, which you can see with all our student wins over here and how much money the students are actually making inside of this community. It's just absolutely insane. Like if you look at the one guy over here, he's made 30,000 Rand in his first month. This guy's made over $5,000 overall and over $600 today. This guy's winning tournaments. This guy's winning tournaments. This guy's making money. Everyone's making money. And you just got to be part of it if you want to go and pretty much learn above and beyond what's happening inside of this entire free course. If you really want to step it up, I know this is a really good strategy, and we're going to break down obviously the live session next video, but also the risk management. But there's so much value to be learned from me. Like I've been experienced with this for over 5 years, and I have a lot to offer, a lot to share, and a lot to teach you to help you become profitable in your journey with quick trading. This has been a very valuable lesson. I think we'll close off with a couple more backtesting examples. Backtesting just being like, okay, this is the formation of a low here. Because of that pullback, we would likely take a trade to the downside, but we actually wouldn't because this is an uptrend, right? So backtesting is just not even placing the trades. It's speaking in hindsight what trades you would normally take. So let's close off with a little bit of backtesting over here, and then next video we'll move on to the live session and also the risk management and how you allocate your risk, your take profit, your stop losses to ensure that you are a profitable trader. The video after that, I will likely go over some psychology and how to overcome any fear, any doubts, any worry, any overthinking, so that you can go out there and perform to the best of your ability. Perfect. So let's do maybe 2 more examples for sells, 2 more examples for buys, and we'll end this video. Cool. So what can we see here? The main formation of a downtrend. So what are we looking for? Well, we see that this is the most recent low over here. All that we're looking for, right, on this low are these moves back here. And whenever it's creating these moves up, we can literally continue to look for trades downwards, right? But only if we had seen a red candle, which we completely did over here. We could probably have taken a trade over there, down for 5 seconds, and you would see it won. Let's look at this one. There's a brand new low that forms there. We see that pullback there. What can we do? We can start taking trades to the downside for 5 seconds, right? And what will we notice? It's very likely that we might have lost the trade over here, but we just take the trade off of there, and what happens? Look, it starts pushing downwards, right? For those 5 seconds. It doesn't have to be red. Just remember that. If you're taking a sell, it does not have to always be red. You can take a trade here. It can stay green. It can stay green at this point here, but the candles move downwards and you've won the trade. That's all that matters, right? And it only lasts for 5 seconds. Like I explained, when you're taking these pullback trades off this point, it's going to stay below your entry point or your entry point or your entry point for more than 5 seconds. So that gives you the advantage, right? Let's do a buying example. And then think will be pretty good. If you are confused, don't worry, watch the video over again and stay tuned for the next video, because that's when I'm actually going to be placing the trades, and it's going to be a little bit more practical, and it will help you understand it a lot better. This is obviously just the introduction of the strategy itself. We're still doing the live session, the risk management. We're doing a bit of backtesting now to obviously get you thinking, to get you going, but the live session is where the real deal starts and you start seeing the money you can make from this, and also how to allocate that risk, and a bit of psychology following that. But here we see an uptrend, right? We're going to finish off with this uptrend. Beautiful uptrend over here. Now, what do you see is this was the most recent high. If you're in an uptrend, you only want to be looking at the most recent high. What do? Imagine we took this point as reference, right? We tried to take a buy over here. We would lose, right? We would lose. It would move down. But then all that we would do is we just take a brand new reference point and then take another 5-second buy. And you would have noticed it stays above this point. Look how it's pushing upwards, guys. Look how it's pushing upwards. If we took this reference point as the buy, and we tried to take a buy upwards because we knew it created a new high over there, we would be good, right? And we would be able to take these retracements, right, when it pulls back down like that, we would be able to take those moves up. One important thing, though, is that if it's breaking the most recent low like this, like that, you need to wait for it to break the low, and then you can take the trade to the upside, right? So you see this is the most recent high of this candle over here in the uptrend. We see that this is the most recent low here, so we ideally wanted to break that low first, and then we can start looking for buys, because it's likely that it would just reverse to the upside after breaking that low, right? So here you can see there's always opportunities to take these buys because you're trading with the trend and you're taking these buys to the upside, right? If we took a reference point there, what do you notice? It keeps pushing up. There's another high there, which is broken. Now we're waiting for our pullback. There's our pullback. Now you see a brand new candle form, so we can't take the trade. We're waiting for a new high to form. There's our high over there, right? So we're going to look for buys. And what you notice from our reference points, it's likely going to push upwards, right? Look, from our reference points, what is it doing? It's going higher, right? Because it's pulling back from our most recent high, and then it will continue upwards from where we take the trade, right? Very simple stuff. You're going to see exactly how we're going to execute this strategy a lot better, right? So that's going to be the plan for next video. The plan for next video is going to be the actual execution, right? The actual execution of the intrabar continuity strategy itself with a live session, right? So we'll be doing a live session, and in doing that live session, we always have to break down the risk management, right? I'll always have to break down the risk management. I'm just going to put risk management there like that, risk management, or else if you have no clear picture of what you're aiming for, right? The plus 12 units of take profit, or staying away from the minus 5 units of stop loss, and risking 1% of your starting balance, right? Of your starting balance. So let's say you started with $10,000. That would mean you would do $100 for every single trade, right? Every single trade until you hit either that, in units. So $1,200 profit minus $500 loss, right? It's important to know exactly what you're aiming for, what your risk is, and how you allocate it during a live session when you're executing it, or else you will just not make money, right? And it's the most fundamental and most important thing. If you don't have a target, you don't know what you're risking, you will not make money with quick trading, right? So next video, we're going to get into exactly how the intrabar continuity strategy is executed in a live session whilst breaking down the risk management. And then likely the next video after that will be a bit of probably some psychology. I think some trading psychology will definitely help you out. And then after that, we'll likely end with a conclusion, and then you should be ready to move on with your trades, right? And in terms of the psychology, it'll just be like how to deal with losses, right? Like if you're in doubt, if you have fear, if you don't have confidence, how do you deal with those losses? But also, how do you stay humble? How do you not get overexcited when you're winning, right? If you can trade emotionless, you will be a great trader and make a lot of money. And if you just execute everything I break down in this free course, you will be well on your way to success. If not, a very good student and a potential student for this entire program, just check the link in my profile if you come to the YouTube over here. and this is obviously where you're watching it, you can click the link over here. Right, you click that link over there in my bio, and it will take you over here where you can obviously join the community and you can see everything inside, all the way from programs to calls to daily lessons to recordings to being able to have that network, a session tracking calculator, quick trading system checklist, a structured trading journal, and a weekly FAQ recording. I'm going to be using a lot of these, like the session tracking calculator and as well as the trading journal, likely in the next video, so that you can obviously see what the tools are like in the community. But perfect, guys. Other than that, hope you are currently enjoying the free course so far, and I'm excited for you to watch this and learn exactly how the fundamentals of the strategy work. And then next video we will get into the live session where I'll show you exactly how you execute it with proper risk management so that you can be very consistent with it. And then in the future we'll break down some psychology, how to deal with losses and wins, and like losing streaks and winning streaks, and then just a conclusion to finish things off. Perfect. Have a great day, and I'll see you in the next video.